Welcome to this discussion on joint venture. By the end of this discussion, you would understand what a joint venture is and the basic accounting principles behind accounting for joint ventures. So, happy learning. Our discussion would be structured as below. First, we will understand what is a joint venture. A joint venture is basically when two or more people come together to do a business. If that is the definition of joint venture, then what is the distinction between a joint venture and a partnership? Next, having understood what a joint venture is and the distinction between a joint venture and partnership, we will then move on to accounting for joint ventures. Accounting for joint ventures usually is of two types. One, where we keep a separate set of books for the joint venture, and where no separate set of books is kept for the joint venture. So each partner, we don't call them partners, we actually call them co-venturers. Each co-venturer keeps accounts relating to the joint venture in his own books. So where there is a separate set of books and where there is no separate set of books for the joint venture. When there is no separate set of books and each co-venturer is keeping the records for the joint venture in his own books, there are two types. One may be one where he prepares a memorandum joint venture account and one where no memorandum joint venture is prepared. When he does prepare a memorandum joint venture account, he records only his transactions, only own transactions. That means if the co-venturer spends money, he records it. But if his other co-venturer spends money, he makes no record of it. On the other hand, there is another system of accounting for joint venture by which each co-venturer records all transactions, whether he has spent or the other co-venturer has spent or received money. Let us begin.